Hi there, my name's Mike Deverell and I'm investment manager here at Equilibrium. And today I'm catching up with my colleague David McKendrick, who heads up our advisor team here at Equilibrium. And we're just having a bit of a catch up following yesterday's budget. So, David, probably not too many surprises in there. One thing we were a little bit concerned about was maybe they might do something with regards to capital gains tax, which they've not done as it seems. But what impact is there on our clients, do you think?
Yeah, afternoon, Mike. Yes, it wasn't the most illuminating budget. I think there is some takeaways from it that we need to be sort of quite aware of. And you know, the principle really seems to be this fiscal drag. It's it's trying to keep to promises that they weren't going to put tax rates up, and they aren't, but they're not increasing those rates in line with inflation. So we've got the fixing of personal allowances, that 50,000 higher rate tax threshold, which over time I think they've estimated it will generate something in the region of sort of 17 billion pounds over that 5-year period, which doesn't seem an awful lot compared to the 440 billion that we're currently borrowing. But I think the impact of that is it will force more people into tax and more people into higher rate tax, which in the end will generate that money coming through. But in terms of real strategy, I think those clients with large pension pots, and we're looking at lifetime allowances, the freezing of that at the current level, so it's not even going to take that anticipated step up in line with the small rate of inflation that we've experienced over the last 12 months. That's going to maybe need us to relook at our plans for clients as well going forward, because all the basic assumptions that we would have had in there of that lifetime allowance increasing in line with inflation won't be happening now. So there may be a few rejigs and plans there that we need to sort of consider. The capital gains tax was one which was highly touted in the papers that it was going to happen. And we maybe think that's more of a stay of execution. We think it is something that will come through. And on the 23rd of March, Rishi's got his tax day, which is following on from the Office of Tax Simplifications publishing of their paper in November, talking about simplifying tax going forward, which looked at capital gains tax. The second paper, and what we think is going to come through from that, is the interaction of capital gains tax with inheritance tax going forward. So whether it comes through then or whether it's an autumn statement and a bit of a warning shot for the next tax year, we'll have to wait and see.
Yeah, but still worth continuing with some planning around that in case for future changes.
Yeah, I think we've still got the £12,300 annual exemption. We need to make sure that we're taking full advantage of those whilst that's still there in its current guise. Also, those lower tax rates. So for investment gains, it's the 10 and 20% tax rates, and for property, it's up at 18 and 28, which is still quite a lot less than the 20 and 40% income tax rates that are currently sort of in play.
Yeah, I mean, we're talking about mentioning property. Obviously, we've seen the stamp duty holiday, if you like, is going to be extended a little bit. So perhaps that might see sort of house prices continue their rather meteoric rise. As always, these things seem to benefit those of us who already own the houses more than the people that are trying to buy them. But
yeah, absolutely. And I think this is it's all of these policies are there to are sort of badged up as trying to get people onto their housing ladder, and moving away from generation rent to sort of generation owned. But there is an impact there potentially going forward. As you say, house prices have increased. I think the last figure I saw was 8% in the last 12 months. But if you're looking at inheritance tax, obviously that will push up people's assets and value as well. And we have this quirky system, which may be part of that tax simplification going forward. But we've got the quirky main residence relief, where you get extra potentially up to £350,000 for a couple on their property. But if we are starting to see property values rise, and maybe off the back of the budget, maybe, and coming out of COVID, maybe markets start to rise, people's overall asset values will probably pick up, and therefore we just got to be mindful of there's a £2 million limit that you start to lose that main residence allowance. So again, it's a bit of forward planning, just sort of checking in that the path we were on before is still suitable.
Yeah. So anything else for individuals? I know that there was a sort of a much sort of touted green savings bond, which I think we're waiting to hear a bit more information about. Anything else we need to think about?
I think for those business owners, I think we have got this change in corporation tax coming in. We've got a bit of a stave execution for that as well. It's sort of 2023, and there is a tapering. It's based on profits between 15 and 250,000. There's a sliding scale there, but it may change people's remuneration strategy. So it might be something to talk to your accountants about, whether you keep on the same path. It probably makes pension contributions actually look a little bit more appealing from an employer perspective. But it may change how people set their businesses up, maybe almost splitting a business partially into a limited company and partially a partnership or LLP or something like that.
Yeah, I mean, that's something I think we were probably expecting, that the corporation tax would start to go back up. I think it was in the manifesto, the last Tory manifesto. From our point of view, from the investment point of view and the economic point of view, what we were keen to see was that there wasn't going to be too many tax rises or spending cuts immediately. We wanted to see that that the stimulus carries on being given to the economy in the short term, and that certainly seems to be the case, because obviously, sort of a basic economic principle, you don't want to be cutting spending or putting up taxes when you're in the middle of the crisis. You wait till afterwards. I think the increase to corporation tax was probably at the higher end of expectations, and the fact that it goes up in kind of one go, really, rather than maybe go up to 22 and then 24 or something like that is perhaps a bit of a surprise. But I think some of the figures that the Treasury put out yesterday says that only sort of maybe 10% of companies would actually end up paying the top 25%. And also, we were discussing earlier this super deduction, where companies can kind of make greater offsets, if you like, of in order to try and stimulate them investing in their businesses. I think is also a positive. So maybe that's another case of getting people to spend now while we got a crisis, and then when we claw back those sorts of relief later on from higher taxes later.
Yeah, that's a good point. I think we're all quite aware that the stock market's quite forward-looking, Mike, and does this higher rate of tax, is that going to maybe affect dividends, and therefore is it going to from an investor perspective, is that going to maybe hinder markets going forward?
I think, to be honest, I think the impact is really quite marginal. I think, when you look at corporation tax around the world, it brings it back in line with some other countries around the world. It's not a particularly high level. And as I say, companies are very adept at kind of keeping those manipulating those profits and make sure they pay the least amount of tax possible. So I don't think it's going to have a particular impact on the market or very few companies. There are actually some companies that have really benefited, I think, from some of these, as I said, the super deduction, this allowance for investment spending. People like BT, whose shares went up quite a bit yesterday, because they spend a lot of their money, or have to spend a lot of money, obviously, on the infrastructure. The other thing from the investment and economic point of view that's quite interesting is the new investment bank. Infrastructure investment bank is going to be based in Leeds, focused in particular on green spending, which is quite interesting. Again, it might only have a marginal impact, but anything that sort of puts money into the economy is helpful for UK assets. There's also going to be green gilts, which we knew about, which is basically the government can borrow money specifically to spend it on renewable investment projects and things like that, which I think, again, might have a positive impact. And I think one of the interesting ones that will be really interesting to see longer term is the slight tweak to the Bank of England's mandate, whereas previously all they're meant to do is try and keep inflation at 2%, but now they're meant to do that plus aid the transition towards a net zero economy. So I'm not sure at the moment what impact that will have, if anything, on monetary policy. But it's definitely one that can keep an eye on it. But certainly not a great deal of market reaction yesterday, either in the bond market or the equity markets at all.
Yeah, I think, and I suppose when you look at all the questions which will come out of this, I think when I'm speaking to my clients are going to be, well, does this maybe eat into the so-called Brexit dividend, or are we still going to? Because I think there was originally this sort of idea that we would be this sort of lower tax sort of environment where we could, hopefully pull in a bit more outward investment. Maybe that's slightly been clawed back.
Maybe you've got this whole free ports idea, which I think is probably too complicated to get into here today. But yeah, I think the key point at the moment is that the government is keeping the sort of spending taps on at the moment and help us. That should help us get through the crisis, and hopefully then the economy will start to be recovering by the time any of those kind of tax increases start to appear anyway. So fingers crossed. It should have we should still see a good economic recovery later this year.
Yeah, well, I think as you said there, it's sort of tough times, isn't it? And I think it does feel that this debt build up is is the highest in sort of peacetime, isn't it, for the UK? And it will take some gargantuan efforts to get us back on that pathway. I think the other day on the radio on the car the other day, it was someone mentioned that if the cost of servicing, if there was the cost of servicing the debts were not by sort of 1%, that to sort of counter that, you'd have to put about 5% onto basic rate income tax, which to me seems really quite scary.
Yeah, it's quite an interesting one, and I think the Chancellor made the point yesterday. It's something that's going to be dealt with by successive governments, not by this government or the next government or even the one after that. So I think it's quite interesting from a government finances point of view. The actual interest cost at the moment is as a percentage of GDP. Whilst the debt as a percentage of GDP is at record highs or very close to very highs, the actual interest cost is actually pretty much at record lows, which is quite interesting. And especially when you take into account that the Bank of England, via quantitative easing, actually holds a lot of the government bonds, and any interest that they get paid on that, they actually give back to the Treasury. When you take that into account, it's literally never been lower. So I take the view that, yeah, it's got to be dealt with, I think, but they've got this scope which they've used, this kind of flexibility in the short term to say that they can, keep the spending taps going, keep the tax rises down for now until we get the crisis completely out of the way, till we've completely recovered, and then hopefully that will not be too far away. So is there anything else that we need to be aware of that we've not covered?
No, I think from our perspective, we will obviously be reviewing strategies for our clients, making sure that what we were doing before to be stay in the same path is the things that we need to bring forward. I think there is some decisions to be made around pensions potentially, or if there's gifts getting made, do we get them done? Because I think it is highly likely that we'll see some significant changes in capital gains tax and inheritance tax going forward. There's been quite a lot of discussion papers around these over the last couple of years, which when I always get a bit sort of more concerned when they are all party ones, and we've had some of those all party papers. So there's a consensus view, and it's interesting because it's not just about increasing the tax take, it's actually about reducing the cost of collecting that tax. So it's looking at that net figure, and hopefully there's some sense when it comes out, but I would definitely, we will definitely be looking back through our current client strategies, making sure they are fit for purpose.
Yeah, so key message is we carry on with that planning, don't put it off.
Indeed, absolutely.
Great. David, thank you very much.
Cheers, Mike.
Cheers.